So this is the part of the show where I talk about what I believe individual investors should be focused on over the next few weeks before they make their investment decisions. We're going to talk a bit about economic data, perhaps maybe even some political data with the elections in the US happening just last night. And I guess kind of lingering on perhaps for the next few weeks. Maybe we'll touch on that a little bit, how that affects the markets and your investment decisions. Talk a bit about corporate earnings. And I guess the overall theme is perhaps not as bad as feared. And lastly, how do you know when you should be adding to an existing equity position? Should you buy more? Should you not buy more? How do you know? So I think it's important to focus on that before you make your investment decisions over the coming weeks. So let's start with economic data or political data. As I mentioned last night, the elections in the US to elect the next Congress, the Senate, the House of Representatives. So far, it looks like Republicans will take the House in a small minority win there, just by a few votes. And the Senate is still up in the air, although many are believing that the Democrats will still hold the Senate. So today, markets are down, perhaps down because of that, or down for a few other reasons. So I think politics, geopolitics, and politics in general are playing a little bit a little bit of a role as to how the markets are doing today. But on an economic data standpoint, we have CPI or inflation data going to be reported in the US as early as tomorrow. Canadian inflation, I think, is coming up in another week or so. You can see here a chart of both core inflation and just overall inflation, still at around 8%, and core inflation of 6.5%, 7%. So inflation is still at multi-decade highs, and that's why we're seeing the Fed continue to raise interest rates. Obviously, all kinds of data that will be released over the coming weeks, whether it's retail sales, whether it's consumers and how they're behaving, their sentiment, how they're feeling, whether they're looking at spending money or not spending money, consumption numbers. All these numbers play a big part as to what the Fed will do at the next Fed meeting coming up, I guess, next month. Bank of Canada will meet next month as well. And all the data that comes out, the economic data, political data, geopolitics, I think this all plays a role as to what the central banks will do. And I guess for now, there's a lot of talk that perhaps the Fed in the US and the Bank of Canada here may raise 50 basis points. They may not go 75, but definitely it looks like rates are going to be higher for longer. And I think everyone is I guess coming to grips with that. We could see another hike first quarter of next year, and then maybe we'll finally get that pause that everyone's anticipating. So economic data, pretty important. You can see here a chart on how the US and Canada are trying to close the gap between inflation and interest rates. Interest rates moving higher, and inflation's just starting to fall a little bit. The second topic that I think is important for individual investors to understand or consider are the latest corporate earnings. And as I said a few minutes ago, I think the overall takeaway for me is they weren't as bad as feared. We had some corporations report earnings that were definitely a miss, a lot of them in the technology space, some of them big cap technology, but we also received some really good positive earnings out of some other names in the pharma space, names in some of the banks, JP Morgan, Bank of America. These stocks, I thought, reported pretty good earnings. You can see a chart here. JP Morgan has really been on fire, really, over the last month or so. You can see the dip coming into early October, and really overall over the last 4 weeks, stock has gone from just above $100 a share to $130 a share. It's been on a bit of a tear. Bank of America, you're going to see a tick up higher in their chart as well. And to me, it's no wonder, right? These companies are doing well. They actually do a lot better when interest rates are higher. They get to charge more for the loans that they provide. So banking does well. Pharmaceuticals has done well. Names like Pfizer come to mind. Amgen reported a solid quarter. They have a new obesity drug that is really causing a lot of analysts to take their expectations higher. In Canada, CN Rail reported a really strong earnings report. They're doing extremely well. So overall, I think it's not as bad as feared. However, most of the CEOs are definitely saying they're seeing a slowdown in their businesses. And that's from tech all the way to really retail and anything else in between. So you can see there a chart of Meta platforms, Facebook, and they've come down quite a bit as well. So overall, not as bad as feared on the corporate earnings, but definitely CEOs are seeing a slowdown heading into 2023. The last topic of the three that I think is important for individual investors, that is, to consider before you make your investment decisions, is this notion of, or the idea of, when is it a good idea to invest more in an investment you have already? For my clients, what I've been doing a lot of recently is buying more of the shares they currently have. So maybe not buying as many new names, but adding to some of the good quality names that they currently have. And I think we have a chart we just showed of Meta. I like to use Meta as a perfect example because I actually received a question from an investor this past week. There's Meta. And they asked me, why would I buy more Meta? Well, with any investment, if you own it currently, if you're going to buy more, I think you buy more of that investment if you firmly believe that that investment will move higher than other alternatives that exist today. So if in this case of Meta, if I believe that Meta has dropped so far right now, and I believe it's still good quality, and we'll get into that in a second, why wouldn't I buy more Meta at the price it is today if I felt that Meta has as good a chance as any investment right now to move higher and make back a lot or some or most of the losses that they've had over the past year? So you want to buy some of the names you currently have if you believe that they're the best, still the best place to be going forward, regardless of what has happened in the past. A name like Meta, approximately 3 billion users use their apps on a daily basis. 3 billion. There's about 8 billion people in the world. So almost half the world's population, half the planet, is using Meta. They have about 2 billion users on a monthly basis. So, if you feel the name like Meta is still good quality, if you feel as though it has come down, but for reasons that they can actually fix, in their case, it's due to the high expenses and the high amount of money, or the amount of money they've been spending on the metaverse over the past year. If they can get their costs under control, if they can start to cut costs, and unfortunately, they for some of their employees, they actually cut about 13% of their workforce today, or they made that announcement today. So that'll go a long way to cutting costs. Then this could be an investment idea for individual investors to consider, again, if they can handle the volatility and the risk level of the investment. So why would you want to buy more of an investment that you already have, whether it's Meta, whether it's Microsoft, whether it's Amazon, and we have charts of those as well, because you feel the company is still good quality, that the story is intact, that you feel as though if you buy more or buy the shares today, that they would be a good investment going forward. And if you don't buy their shares today, you could always hold on to the shares, but your average cost would still be quite elevated. So if you're going to hold a name like a Meta or a Microsoft or even an Alphabet, Google, you probably at some point want to buy more of those shares to bring down your average cost so you can get back to break even quicker. So what I've been doing for many investors is exactly that, buying or continuing to buy good quality names at a lot cheaper prices, because I believe these names will be the names that you can own for defensive purposes, but also will be the names to rebound first when this market turns around.